Hey guys, in this video we're talking about using a long-term care that's part of a life insurance policy. So essentially you're purchasing a life insurance policy with a long-term care rider to provide you with future long-term care benefits. That's the topic of today's video. So we're going to cover how this all works as well as the pros and cons of using it. So if this is your first time here, make sure to like and subscribe so you don't miss future updates like this one. So basically the strategy here is you're purchasing a permanent life insurance policy. Could be whole life, variable, universal, or index, doesn't matter as long as it's one of the four permanent policies. And you have to make sure it has a long-term care rider attached to it. Now there are two types of long-term care riders. There's 7702B, which is what they call a true long-term care rider. Basically when you have that kind, you'll pay an additional premium for that long-term rider. These are the ones that actually count as long-term care riders in the eyes of most states. So if for Washington State you link to the exemption, you make sure you have that rider or that type of long-term care add-on to qualify for the exemption. In the future, other states may also have these requirements, so it's something to be aware of. The other and more common one is the 101G. This is critical and chronic care. It actually covers the same thing, but because it falls under a tax code, it technically doesn't meet the definition of a long-term care policy in the eyes of most states. So just something to be aware of there. Now, so how does the policy work? Essentially, all you're doing is purchasing a death benefit, and the rider just lets you use it before then for your own care. So you're going to purchase this death benefit. If I never use it, hey, as a death benefit, it pays tax-free to my beneficiary. So the money I put into the policy doesn't just go to waste. Somebody's getting money somewhere down the road. So what the rider does, it just gives you a percentage of your death benefit to use while you're living, and it's going to continue until the policy is either exhausted, or you pass away, or for some reason you no longer need the coverage. You can turn that rider off and stop the distributions. So it works on a percentage. So let's say you purchase a policy with a 3% rider on it. It gives you 3% of your death benefit per month. You got a $100,000 policy. That's $3,000 per month until the policy is exhausted in roughly 33 months. So when you're looking for these riders, if you get a smaller one, say with a 2%, the benefit's going to be less, but it'll last longer. If you go higher end to like 4%, higher payments, but you're going to use it up quicker, usually within 25 months. So now, what are the pros and cons of using this type of strategy? So the pros, as I mentioned earlier, this is not a use it or lose it type of plan. Someone's getting money one way or the other. Whether that money pays out 100% to you to use for your long-term care, or you don't use it and it pays out tax-free to your beneficiaries, or a combination of the two. If you only exhaust 20% or even 50% of the benefit, the leftover still is paid out tax-free to your beneficiary. In addition to that, the long-term care premiums are not going to increase in this type of strategy, so they're fixed and they're not going to rise like they would in a traditional long-term care insurance plan. So as far as what are the cons for this type of strategy, these riders don't qualify for the partnership protection programs, so you're not going to get that step up in asset protection when looking at getting onto Medicaid. In addition, you also have to pay separately for that long-term care insurance rider. So just an additional cost to the policy. Some other things to keep in mind is that when it comes to payouts, they can be done on a reimbursement or an indemnity basis. So a reimbursement is you go and you spend the money, you have to submit receipts and wait for them to reimburse you. Indemnity is you don't have to submit any receipts, they're just going to send you the money directly. So there's a big difference between those type of benefits and payouts. So another thing to look at before purchasing a plan. One other consideration is that life insurance and the long-term care part of it are underwritten separately. So look at each in its own silo. So for instance, someone could apply for one, qualify for life insurance, but not qualify for the long-term care part of it. So just because you're applying and accepted doesn't mean you're going to qualify for both. If you want more information on this, as well as what other options you have available, then in the description below, I have a free guide on how to manage long-term care plans. I hope you find that helpful. Make sure you check out these videos over here for more information, and remember that your future depends on what you do today.